lives for the better.
Our vision is to be a transformative platform that exposes lies and reveals the truth. Mind Changes International, we on a mission. Masking the falsehoods with every new edition. We're here to enlighten your mind with this vibration. Expose the lies, speak the truth, normal conversations. Mind Changes International, we on a mission. Masking the falsehoods.
Welcome to Mind Changes Podcast. I'm your host, Lamar Blakeney with the most. Yes, y'all. Yes, y'all. Yes, y'all. Listen, we back with an amazing episode. Listen, some of you are getting denied a mortgage. Not because you're not capable. You're getting denied because you've never been properly prepared. And even more dangerous than that, y'all. Some of you are about to finally get approved, but nobody has prepared you for what happens afterwards. And listen, I got an amazing guest that's coming onto the platform today for the very first time because, you know, getting the house is one battle, but keeping it is a completely different war. All right? So tonight we're going to talk about some amazing things. We're going to deal with both sides of it, people. We're going to deal with both sides of it, people. So listen, here on the Mind Changes Podcast now, if you want to be a part of this conversation, all you got to do is click on the YouTube link and you will be able to respond to us directly. So tonight, we have a very, very special guest. A man who has spent over 2 decades in the lending space, helping individuals, families do what many people think is impossible. Guess what that is, people? Become a homeowner. So not only that, and I know I'm taking my time before I bring him up here, y'all. That's why I'm teasing you a little bit. Not only that, let me tell you what else he does. He specializes in helping people improve their credit through financial literacy and real education. And he's also helped business owners position themselves to qualify for funding. So if you're a business owner, you want to be a part of this podcast tonight. And listen, and one thing you need to know, that traditional banks will never approve. So he helped people get qualified when traditional banks won't help you get approved, right? So ladies and gentlemen and ladies, people all over the world, listen, I want to introduce to the Mind Changes Podcast licensed loan officer, Mr. Christopher Butler. Welcome to the podcast, sir.
How you doing?
Oh,
Thank
man,
you for that
I'm doing
warm
great.
welcome.
Oh, I'm doing great, man. I'm looking at you, making sure you're a little off-centered, Dad. Let me kind of get you right here. Yes, sir. We live. Y'all told y'all I don't be playing around. We live. We all the way live. That means he didn't sit back in the same spot I told Mr. Butler to sit in. So listen, welcome to the podcast, sir.
Thank you.
Yeah, listen, you and I have been knowing each other for a while. We've always talked about, getting together and really, really doing something, right? But we never knew that it was going to be on the podcast. We never knew that, right? So we're going to get right to it. Like I stated earlier, listen, if you're on the YouTube link, you can type in your responses, and we're not going to ignore you. We are going to get involved. Don't mess with your camera, sir. I got you over here, all right? Okay?
All right,
I'm the engineer today, all right? Don't worry about that top part. We good. Don't even worry about it. I got you. Got to keep you centered. All right, so listen. So, Mr. Butler.
Yes, sir.
What are the absolute essentials someone must have in place before even thinking about applying for a mortgage? Because I'm gonna take notes too. So talk to us.
Well, the main thing, and I'm glad you asked that. I'm glad you started off with that. The essentials are they got to have patience.
Uh-huh.
And the reason I say that is because it's going to be probably, if not the most important buying decision of their lives. and they got to have patience because it's not like they're going to buy a wedding ring or they're going to buy a car or
Hmm.
anything like that. They're buying a home, and it's gonna take patience on their part to learn to go through the process because it is a process in buying a home.
Okay. Got you. So, what does a lender really look for, Christopher? You want me to call you Chris, man?
Yeah, you can just say call Chris. Yeah, that'd be
Okay.
fine.
No, I'm be professional, Mr. Butler. Mr. Butler.
Okay.
Yes, sir. What does lenders really look for behind the scenes that most people just don't understand?
Well, when they look at you, they look at your buying and your spending habits. They
Okay.
look at what are you spending your money on. They also look at um, what's your liquidity. They want to see that. Um, they also want to see how are you spending your money and are you spending it responsibly.
Okay.
That's what they're looking at.
Oh man, they be mad with me then because I'm an irresponsible spender. My wife watches this now. She is the banker. My wife is the accountant. She's the banker. She handles the money because, dude, I'm the kind of guy like, oh yeah, let me get that. All right. Now, you know what? I seen this on TV. That's why sometimes I have my phone, Chris, and she'll say, "Don't you order nothing? Don't you order nothing?" I have Amazon syndrome and I have eBay disease because I will order something in a minute. So let me ask you this. What is considered a healthy financial profile?
Yeah. A healthy financial profile is when they can tell that a person basically they have money
Hmm.
at the end of the month. Um, they pay their bills on time.
Okay.
Um, they have a pretty good credit history, meaning they got the proper trade lines that's required, which we look for 2 to 3
Okay.
trade lines. We also look for we want to know what's their high credit.
Okay.
Um, is it 1,000? Is it 5,000? And we can help them grow it from there.
Okay.
So the main part is they got to know what's on their credit report. And I know I'm getting ahead of myself, but it's really important
Okay.
for them to know what's on their credit because a lot of people,
Mhm.
Lamar, they don't even know what's on their credit,
Oh wow, wow. So
let
listen, you
alone what their scores are.
yeah. So you said something that some of our viewers may not know that terminology. Tell us what a trade line is.
Yeah. A trade line is basically you being able to have, so let's say you have a Chase card, that's a trade line.
Okay.
Um, you have a credit card that was issued to you by Visa, Capital One, trade line. Um, those are trade lines, and you wanna keep them paid on time, um, early if you can, but
Hmm.
for the most part, don't pay them late.
Got you.
Because when you pay them late, you're gonna get it's gonna hit your credit
That's
when you
true.
pay late, and when you pay consistently late, that's gonna hit your credit even more, and you might even lose that credit privilege. I know I'm getting ahead of myself again, but
No, keep going, keep
but
going. You did good.
yeah, so you want to keep your credit as healthy as you can. You want to pay your bills on time. Um, you want to pay everything down. Um, Understanding what utilization is. Um, a lot of times they tell us our utilization needs to be at 30%, but I tell people your utilization really needs to be at 15 to 20%. Um, so yeah, so 15 to 20% is where your utilization needs to be. And when your utilization is under control, you have the ability to get more credit.
Got you. Yeah, and I explain what he's saying to y'all is this. if you have a credit card for $500, right? That means $15 per $100 would be that utilization. So that meaning that you don't want to be 5 times over $15 because now you're going over that 30%. I'll make it simple. If you got $100 and you use $30, if you go over that $30, then what the credit bureau does is they start affecting your score because they say, hey, you're living off your credit cards. You are not. I did my homework, Chris, because I knew I was coming up here with a master. So that means you're living off of your credit cards, and that brings your score down. So that's one of the
Yes.
things that they use to base your score. And Sam So Blue One says, I know people with 750, and they are not. What's that? Lendable. Mm. So answer that for him, Chris. I gotta blow it up some so I can see when people. I gotta make this larger. That's why I had a hard time reading what you said, Sam. So there we go. I got it larger now. Okay, he says I know people with 750 scores and they are not fundable. So Chris, what would make a person with a 750 score not be fundable?
Yeah, what makes them not fundable is the fact, as we touched on it, when their utilization is so high,
Uh huh.
they don't have discretionary income to go any higher.
Mm. So would
Yeah,
that mean that income to debt ratio is too high?
exactly.
Okay. Got you.
And
Got
what
you.
we and getting a little bit more into that, when we do a FHA loan,
Uh huh.
our ratios on the front is 31 and our back end is 43.
Okay.
Some of our programs will allow us to go as high as 50% on the back end, but we have to be careful when we do that because we don't want to cause them to be, in other words, they have a house payment that's unmanageable.
Okay.
In other words, they got to be able to live after they pay their mortgage. They got to be
Got you.
able to pay their light bill. They got to be able to pay their gas bill. They got to be able to pay all their other bills. They got to be able to buy food to eat.
Yeah.
So yeah, so we look at the back end ratio as 43 to 50%.
Yeah. Now, thanks for the information. As I was doing this, studying for this podcast, I realized something. And I don't know, Chris, you may already realize this. Sam Blue may have realized this as well. I realized that we get set up. And this is how we get set up. They use something called the gross. I call it the ghost, right? They
Mm,
use gross to determine what you qualify for. So let's say
yeah,
I make 80,000 a year, right? But only 56,000 hits my bank account. But the
right.
loan was based on 80,000. And so
Yeah,
they start basing my payments off of 80,000 when
right.
40% at 35 to 40% of that is never hitting my pocket. So I found out the reason that rich people says my net worth is this and poor people says my gross is that because rich people understand you live off what you catch. I call that the net, right? You got to live off
Mm,
what you catch. And I'm learning this at 58, which is a shame. But you live off what you catch. If we based everything we buy off of our net, we will never be in any financial hardship because you will be actually qualifying for what you actually have or
that's true.
actually get. What do y'all fellas think about that?
That's true. Yeah,
Yeah,
that's a good way to look at it.
yeah. And Sam said this. He said some. He said some are too. He said some are too credit card heavy. It's not always good to use credit cards for everything in some cases, and I agree with you. It's supposed to be for emergency purposes only. I agree with you. So I got another question for you before we go to our next segment.
Okay,
If someone wants to own a home within, let's say, 6 to 12 months, where should they start?
we touched on it earlier, but what we should start at is doing the credit. We got to see what's on their credit because they might have things on their credit that they weren't even aware that were there.
Mm-hmm.
So the first part we got to do, we got to get the credit, and we do a comprehensive credit um, where we get three bureaus. So we get the Equifax, TransUnion, and Experian. So we pull what's known as a tri-merge,
Mm-hmm.
and then we sit down with our client and we go over that tri-merge with them together, line by line. Um, and then they tell us what's on their credit that they know, and the things that are not supposed to be up there. We make notation of that, and we help them rectify those things or challenge or dispute certain items that are not even theirs. And they have a right to do that as well.
Yeah, wow, wow. Hey, Sam says this is how they get college kids to graduate from college, right? In their last semester, they receive multiple credit cards offers before they even have a job. And guess what? I was a victim of that. When I graduated from
Yeah.
college, man, I had like 4 credit cards. Nobody taught me
Wow.
how to use them. Nobody taught me the significance of credit, that you don't max it out, and that, and so I didn't know how to play that game right, right? And he says also when getting a home, having even one or two NF, NSFs may
Oh yeah.
prevent the person from getting approved. Wow. Are you for real?
Yeah. Yeah. So if they have like a NSF could be them going they're overdrawn on their bank account. Yeah. So that will that can be taken into consideration and could disqualify them from being approved with a major bank or lending institution. So
Mm,
that was a
okay.
good question.
Good question, Blue.
Somebody, yeah.
Sam, okay. So listen, we're going to go to the credit questions, right? So let me ask you this. What credit score do you realistically need? All right, it's a two-part question. And what option exists for people below that?
Okay. So I have credit programs that we can go all the way down to a 580.
Hmm.
Um, but
Is that an
they got to
FHA
have,
loan?
yes, that's a
Okay.
FHA loan. And that is a FHA loan, and we're gonna call it a QM. So it's a qualified mortgage. So that means I'm gonna get the 2 years tax returns.
Mm-hmm.
I'm gonna get the W-2s. I'm gonna get 60 days worth of pay stubs, bank statements. I'm gonna qualify them. So when they before they get to go to a realtor, this
Mm-hmm.
this is the mistake that a lot of them make. They'll go talk to a realtor first before they come to a person like me. So when you get in front of that realtor, they're gonna take they a lot of them won't even let you shop unless they see a what's known as a pre-qual letter from
Right.
a person like me
Mm-hmm.
that's qualified them based on those items that I just mentioned.
Okay. All right.
So
Cool.
if they haven't had those things looked at and verified that they said they have in the bank,
Uh huh.
they can't even go out shopping because I have to produce what's known as a pre-qual letter.
Okay.
And when I give that pre-qual letter to the realtor, they make offers based on that pre-qual letter, and we have a maximum amount up there for them.
Hmm. Hmm. Okay. All right. That's good to know. Listen, if like I said, if you're out there, you're listening to the podcast tonight, I want you to chime in because there's no dumb questions. You ever been in class and somebody asked a question you was too scared to ask? You like, I'm glad somebody asked that question. Hey, don't be that person. Right now, this podcast is to educate you so that if you're a person that's looking to purchase a home or to be a first time homeowner, listen, this is the show for you. So I done called you Butler. I done called you Chris. I'm gonna settle with one of them, right? I'm gonna settle. So Chris, how important is credit history versus credit score? Because I know a lot of us. Because I think Sam was talking about that when he said he knows people who got a 750 score, but they can't. They're not fundable. So Sam, this is going to kind of jump on that question you just asked. How important is credit history versus credit score?
Now, credit history um, is very important. Um, and I always tell people, you know, we want to take into account your whole history. Um, and if we have that, like if I have a person that has had some hiccups,
Mm-hmm.
and let's say they got a 610 credit score. I can get them approved because of the duration of the credit history.
Mm-hmm.
And that's what they look at. Banks look at, okay, I see you had a couple of lates 3 years ago, but they didn't know that person was going through a divorce.
Okay.
They didn't know that person lost their job.
Mm-hmm.
So they didn't know how to get the creditors on the phone. Like a lot of times when when people are facing issues, the first thing they do is they stop answering the phone.
Yeah.
But if you get on the phone with your creditor, there are programs out there that can help you
Yeah.
keep your credit good while you're going through the life-changing circumstance. And then once that circumstance has been dealt with, you go straight on back into where you were.
Yeah.
So if you
And
got a job loss,
mm-hmm.
they will hold you until you get a job,
Yeah.
whether
Yeah.
that be 2 months, 3 months. But you have to know how to request those programs to help you.
Yeah. And these were some of the laws that was placed by our government as far as, credit is concerned. So a lot of times they put it in something like a forbearance phase, right? Where they'll say, okay, listen, for 1 year, we're going to make you interest free, but we're going to give you a payment that is easy for you to make, and then after that year, we're going to come back and we're going to address it. But you can add extra payments to it if you want to, because they're really giving you a interest free year to bring that balance down. Right.
Right.
So listen, y'all. I started studying this as soon as I knew me and this young man was coming up here, because I didn't want to seem like I didn't know what I was talking about. So Sam said that's why some houses are under contract, and then a couple of weeks later you'll see the house back on the market. That means that
Yep.
somebody, they jumped out too early. I got it. Jumped out too early. They didn't come to a guy like Chris. See, Chris is the guy you come to. Chris is the guy you come to before you go buy the home, because he's going to let you know whether you can do this or not, whether they will say yay or nay. So listen, people, I'm going to give y'all Chris' number, but you're going to watch the whole podcast. We're going to give it to you at the end so we can sit here and you can have somebody that you can call up, one of our brothers, and get the information that you need. So, Chris, what are the biggest credit mistakes people are making today?
Yeah. We touched on it earlier. Like
Mhm.
they don't see the benefit. Well, they don't see the importance of paying their bills on time. Um, they that's one of the biggest mistakes
Mhm.
is how you pay your credit. I explain it to people like this. When a lender looks at your credit, it's
Mhm.
almost like they're looking at your blood type. They can see everything about you.
Yeah, your credit is a report card.
Yeah, it's the report card of you, and
Mhm.
it says something about you when I look at that, and I also look at what kind of savings you've been able to put
Mhm.
aside over the last 3 to 6 months. Um, those things are very important, very important.
Yeah. So, um, this is another question I want to ask you. Should some people focus on paying off debt, or should they focus on building new credit first? Which one should they do? Should they focus on paying off debt or new credit first? Building new credit first.
They really need to focus on, and we touched on it a little bit earlier, disputing or at least knowing where that challenging credit is
Hmm.
before they add on new credit. Because what new credit can do, it can help you with a higher score,
Hmm.
but that bad credit or that challenging credit is still going to be there.
Yeah.
So if you're gonna, the proper answer should be, we want to do both. We want to
Gotcha.
work on the new credit, and we want to also challenge the old credit or the challenging credit that might be bringing the scores down.
Yeah. And Chris, while I was
Mhm.
studying for this, I came across something, so I need you to correct me if I'm wrong. I think I
Okay.
got this right. It's around charge offs. I realized that charge offs. So let's say people, and Chris, correct me if I'm wrong, because you the guru. I'm just a new guy, just trying to learn this stuff. All right. So I'm not gonna step on your toes, but I want you to. I want to say what I've felt like I've learned, and if you think that I'm not correct, I ain't gonna be mad. Just tell me, say, hey, brother, that's not absolutely correct. So I was looking up at charge offs, right? When a company charge off something, they're reporting that as loss and they reporting it as income for you. They supposed
Yes.
to send you a 1099, people. So
Yes.
you cannot post a chargeback on somebody's credit because you can't say you can't post my income. You're supposed to send me a 1099. If they didn't send you a 1099 and they put a charge off on your credit, that means they got credit from their taxes. Tell me why that's wrong, Chris.
Well, you just gave that was accurate. They're going to give you, so they can't get both. They can't keep reporting it if they've already written it off. But if you don't know how to challenge it to
Mm-hmm.
get it off of your credit, because you alluded to it in your first when you first started, it's a 1099-C, and that stands for they basically wrote it off.
Mm-hmm.
So meaning they charged it off. So 1099-C. And you're to take those 1099s that you get
Filing
and take them to
taxes.
your, yes, file it with your tax preparer. So that's kind of like a tax question, but
Yeah.
yeah. Um, Once you find and you have proof and you got the 1099s,
Mm-hmm.
you can report that to the bureaus, and the bureaus are supposed to remove it in 60 to 90 days. But if you don't know how to do that, you could do more harm to yourself than good.
So let me ask you this. So you are supposed to request a 1099 from that company, right? Then
Right.
send that to
Well,
the credit agency.
they're supposed to provide it.
They're
But if
supposed to
they
send it to you.
don't, right. If they don't, then that's you got to request it.
Okay. So let's
Yeah.
say Mr. Jones requested the 1099. When Mr. Jones get the 1099, his job is to send it to the credit bureaus, right? And say
When he
this is
writes his,
income, not bad credit.
right. That's because that was the income that they wrote off as a loss.
Got you.
Yeah.
Okay.
So he's supposed to be able to take that 1099
Mm-hmm.
and write it to each bureau that these things have already been taken care of, and he's already wrote it off of his taxes.
Mm-hmm.
The creditor did, and so that's all they need. And to rectify that they would need about 30 to 60 days
Okay.
for that to show on your credit report.
Now you see, people, this is some good information because I'm sure somebody out there has a charge off and they was wondering how I get this off my credit. So Chris just told you whatever I learned, I just kind of brought that information to the platform. So let's talk about the now questions, Chris. All right.
Mhm.
Why are so many people getting denied right now?
That's a very good question, but you got to look at the climate that we're in.
Uh-huh.
Um, in other words, people's wages are not going up. Your gas prices. I looked at gas today. Gas is $4 a gallon.
Yeah, man. Somebody had to poop in the tank. See, I know
Yeah.
I say some crazy stuff, y'all.
So
You
you
got
got
gas,
so you
right?
got yeah, so you got gas prices up. You got food prices are not coming down. You got um you got all these things that affect our dollars, but the people's wages are not going up as fast to keep up with the cost of inflation.
Mhm. Wow, that's true.
So so when things are paid, that's reflecting on their credit report, and that's what's helping some of these people get declined.
Wow.
um, because they want to pay their bills on time, but they don't make the same amount of money, or they don't make more money to keep up with the pace of inflation
Hmm.
and the tariffs and all these things that are affecting so many people today.
Okay. So listen, okay. Great, 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 great. Listen, y'all, if you want to respond to this podcast, you got a question for Chris. Listen, you're able to get your question answered for free versus paying for a consultation. Guess what? You got it here right here on the Mind Changes podcast where you can come up here and get your questions answered. So if you're on YouTube and you have some questions, or if you're on Facebook, hey, put it in the comments. And what I'll do is, because we used to get the Facebook um comments, it used to show up on this platform, but something happened with Ecamm. That's the system that we use, where it's no longer showing Facebook comments, and I'm disheartened about that. But I love this platform. So here's the next question, Chris. What are the
Yes, sir.
top 3 deal breakers, my brother? Top
The
3
top,
deal breakers
when you say deal breakers,
when it
what are you
comes to
referring
getting
to?
denials.
Okay. Uh, we alluded to some of it. Um, if they haven't been on their job more than 2 years,
Uh-huh.
because we got to have 2 years of work history. We got to have 2 years of residential history, so we got to have them there.
Mm-hmm.
And then if their credit is below, let's say a 570,
Mm-hmm.
then but that doesn't kill them. It just means that we have to go back and help them get to the point where they can move forward.
Okay.
So time on the job, time at residence, um, those are the main, what they like to say. Those are things that can hurt you in the beginning of a loan application.
Okay.
So
Hey, Sam got a question. He said, why
yes,
would someone request a pay to delete or request a pay to delete pros and cons? I don't know if he's saying that correctly. He says, why would someone request a pay to delete pros or cons?
pay to delete. Oh, he must be talking about a credit repair program.
Oh, okay. Okay.
Well, when you where they got these programs out that they say if you give them a fee, they can basically clean your credit up,
Mm-hmm.
so to speak. Um, and the only way you can clean your credit is to pay your bills on time.
Mm-hmm.
Because when you pay somebody that money, those things that they might have been able to get off for you,
Mm-hmm.
some of those things can be put back on if the creditor finds out that they got removed without being paid.
I got you. I got you.
Yeah.
And look,
I
before we
think
go,
that's I think I think that's what he might be talking about.
okay, before we go
Paying to
further,
delete something.
yeah, before we go further, I forgot to do some house cleaning right quick. I got to do this disclaimer because I ain't trying to get kicked off of YouTube and I'm not trying to get kicked off of Facebook. So let me give the disclaimer right quick. All right. The views expressed in the Mind Changers podcast are meant for informational purposes only. We do not represent any organization, and we are here to foster true and good dialogue, and we're not trying to promote any misinformation. Listen, listener's discretion is advised. Listen, I messed that one up, but listen, we're gonna come back to this thing, all right? So I had to give that, man. I forgot because I was so excited about this, but he said yes. So I guess you answered his question. Sam said yes. Okay, so before we get into strategy questions, I have one more question I need to ask you about denials. Right? What's
Okay.
hurting people that they don't even realize?
Hmm. Hmm. Basically, they don't understand the power of the buying power of their credit.
Okay.
Um, and that's what's hurting them, because if they did, a lot of the buying decisions that they're making now, they would never make. Um, so they got to look at that, and that's why the consultation that we do, a very comprehensive credit consultation when we get the credit in front of them,
Mhm.
is the first step in us understanding how long is it going to take us to get them to the point where they can become a homeowner?
I got
Is
you.
it is it 2 months? Is it 3 months? Is it going to be 6 months because they had some major things that hit their credit?
Okay. Hey, Sam said, I guess we didn't answer this question correctly. Sam
Okay.
said, calling the bill collector and asking them to allow you to pay through old amount and they delete it. He says they delete the file off their credit. So I think I'm saying it right. I gotta expand this, man, because it's so small from where I'm at. Okay. It's almost out of the screen, but I can read it better. Okay. He says no. He says calling the bill collector and asking them to allow you to pay through old amount, and they delete that from the file, which they're going to take it off the credit. That's what he was talking about. So
Oh, okay.
yeah,
Okay.
that's what he was talking about. Got another question for you. Um, what? So for the viewers and for everybody that's watching this, what loan programs are available to most people, right? That they don't know
Yeah.
about.
Yeah. Well, everybody knows about FHA,
Uh huh.
but and for our veterans, we have the VA loan,
Hmm.
which is a very good loan. Um, and if you have what's known as a USDA loan, which is 100% loan,
Okay.
but you have to get a home in a rural area. And what does rural mean?
Country
Rural is yeah, it's got to be in the
in the
rural
in the
area. So
country.
yeah, so it's got to be 25,000 population and under makes it
Oh,
a
wow.
USDA loan.
Now
And so
that's some
you're
good
thinking,
information, man.
yeah, so you're thinking, well, what is that? Well, I remember when they were first building homes out near the airport.
Uh huh.
At one point in time, that was a considered a rural area,
Ah,
but it's no longer rural because look
the
at what the
population.
airport done. The population then skyrocketed,
Yeah,
so it's no longer USDA. Only certain parts of it.
I got you. I got you.
Mhm.
Got another question for you. Are there programs for first time buyers or credit challenge individuals?
Okay, so we do have. So what we do is we deal with the credit. The first step we're gonna do is deal with the credit. Um, First time home buyers.
Hmm.
Um, we do have that. And so what we tend to do is we want to hang our hat
Hmm.
on the being able to give them the proper advice, and they can see where their credit went. And I'm gonna be honest with you, over 80% of the people that we sit down with them with their credit report,
Uh huh.
they know about 80% of what's on their credit already. It's the small things that
Yeah.
got by them, um, and we're able to help them address that because when we have the credit report, it'll give us the name of the creditor, it'll
Hmm.
give us their phone number, and I'll be able to provide them with an account number. So when you call to check on this creditor,
Hmm.
you'll be able to give them accurate information, and you can tell them, hey, that's not my debt, I never got it, or yes, that's my debt, I
Okay.
thought it fell off 2 months ago. Yeah, you'll be able to give them accurate information because we're going to be able to give you the information straight from the credit report.
Got you. Got you. So I got one last question on this segment. I
Mhm.
got two, but I'm gonna see which one I'm gonna ask you.
Okay.
Okay. What separates someone who gets approved quickly from someone who struggles?
Yeah, it's one simple word. It's discipline. So if you get approved quick, um, you more than likely had all the documents that I needed. You provided them to me in a timely fashion. In other words, you gave me all the necessary documents.
Hmm.
And the reason why someone may struggle is because it might take them some time to gather all those things.
Okay,
Um, it doesn't mean they don't have them. They're just not as readily accessible for them to just put their hands on it.
I got you.
So yeah. So when you come to me on Monday and I have you already pre-qualified by Wednesday, you gave me everything I needed.
I got you. I got you.
But if you come to me on Monday and I call you Friday and you still haven't sent me those documents,
Hmm.
that might be an issue.
Okay. Okay.
Yes,
All
sir.
right. So we're gonna transition a little bit. Okay.
All right.
Can Chris? Can you share with our viewers maybe a story of someone you help, go from denied to approved?
Yeah. I actually he went through it was a bad divorce, right?
Hmm.
And when we pulled his credit, he had a 572. And but what I did was I was able to give him a report that was about 3 pages long, and it showed him what he needed to pay down and what he needed to pay off.
Okay.
Now the report was about $11, but it gave him an outline so we didn't have to guess. Um, and he was able to pay down a lot of his debts,
Uh
and
huh.
some of them he was able to pay off. And what happened was when he paid those things off from his divorce settlement, his credit score went up about 50, 60 points. He had a
Wow.
so he was at a 572. When we were done, he had a 642. So his scores went up by more than close to 68 points,
Wow.
which was great because he was able to get approved for FHA. We were able to get him a very, we were able to basically get him a better rate, because if his credit score would have stayed stuck at a 580 or 590,
Uh huh.
he would have got funded, but his interest rate would have been really, really hard.
Been highest blood pressure,
Right.
and we
So
know blood
because
pressure
he
kill
was able
people.
to, yeah. So because he was able to get the his credit score up, it made us easy on the back end to fight for the better rates for him, like we were able to do.
Wow.
And he bought a brand new home, $300,000 home
Wow.
in I want to say it was Sanford. Yeah, it was Sanford. Um, he was able to buy a brand new home, never lived in, and
Wow.
he was so happy. He was so happy. I'll never forget when he got his keys at the closing. I just love seeing that smile on people's faces.
Wow. Wow.
You
Wow.
know, when they get when they get those keys in their hand, and they just you can see that a light bulb goes off. They're
Gotcha.
very, very happy about it. It's hard to describe, and
Hmm.
I hope that I can make more people that are part of this podcast either live or when they go back and look at it again. I
Hmm.
would love to make you a homeowner as well, and you have that same feeling.
Wow. Wow.
Um, yeah, yeah, it's a great feeling to see it and experience it with them. It's a great feeling.
Yeah. So listen, y'all, if you're watching this podcast, right, please inbox me or comment your information. I will get you connected to Chris. There won't be no issues. I will get you connected directly with the man with the plan. So, Chris, how important is financial literacy in this process?
Yeah. Financial literacy is very important. Because when you know and you have knowledge, um, you won't make the same mistakes that you've made in the past. Um, your buying patterns will be much better. Um, you'll be able to manage your money a lot better. Um, you'll be able to do things that you really, really need to do.
Okay.
Uh, but it's just a better way to do things. Um, understanding your ratios, understanding where your how can I say this? Your your taxes and where you are as far as your tax bracket is concerned. When you know those things,
Mm-hmm.
you move a little different.
Yeah.
The uncertainty is not there. Um, the confidence is there.
Wow.
Yeah.
Hey, what's it? What's it? Shan Tennyson 5992 says, true story, Chris. Somebody's up here validating you, brother. Said, true story, Chris. Hey, thank you for your comment, young lady. True story, Chris. So listen, man. Listen, Chris. First of all, man, I've been wanting to get you, man, you've been wanting to work together for a while. We're not finished. We about to transition, but we're not finished. What you gave us, I believe, is powerful, right? You just show people how to get the house.
Yes.
And if you really want to get the house, you got to reach out to me so I can get you connected to Chris. But now I need to ask the question nobody asks, right?
Okay.
What protects them after they get the house? Oh, is Shantae Nelson? I think I'm saying it right. I'm gonna tell you, I will mess a name up in a minute. Look like Shantae Nelson. Do you know Shantae Nelson?
The Nelson. Oh yeah. Oh, what am I thinking? Yeah, that's Coach Tay.
Okay. Am I saying her name right?
Uh-huh. Shantae Nelson. Yep.
Shantae Nelson. Okay. All right. Cool. When I seen the A there, see, my wife's name is Shantae, her middle name. So when I saw the A there, I was thinking Shan. So, all right, Shantae. Thank you for joining the podcast platform, Miss Shantae Nelson. Thank you so much. So listen, so what protects them, Chris, after they get the house? And that's what we're going to talk about. We're going to talk about the truth about mortgage protection. So we're transitioning now, right?
All
Because
right.
let me say this, and this is something real. The bank qualifies you, but the bank does not protect you. The bank qualifies you, people, but the bank does not protect you. See, most people think, Chris, once they get approved, they're safe. They believe they're safe. They believe the system is designed, Chris, to protect them, but it's not.
That's right.
So what we're about to do right now, we're going to expose the bank. I'm here to expose the bank because I did my homework. I'm here to expose the bank. What banks typically offer is not protection for you and your family when they give you mortgage protection. It's really protection for them. Am I right, Chris?
That's true.
It's not for you. So what I'm going to do in this segment, I am going to break it down. Now, I've been doing mortgage protection. See, I'm not a mortgage specialist, but I've been doing mortgage protection for over 20 years. So let me break this down, right? Chris, what happens is when you get mortgage protection from a bank, they give you what's called a decreasing coverage, right?
Okay.
They give you a decreasing loan. So let's say your mortgage is $350,000. So when you sign it, they give you $350,000 worth of what we call credit life. They may call it something else, right? And let's say in 20 years the house is worth 220, and then I'm say 10 years is worth 220, and let's say 15 years is worth 190. Now, if the husband dies or the wife dies, all they covering is the mortgage for 190. Nothing is coming to the home for the wife. Nothing is coming to the home for the husband, and your payments stay the same. So your coverage is decreasing. Man, your coverage is decreasing, but your payments are staying the same. And guess what? It only pays at death. No living benefits, no control. You pay or be canceled. It's like renting a house. So let me see what Sam Blue is saying, because Sam has been engaging with us today, and I love this, man, because it lets me know that somebody values the information we bring in for me. He says, "What are the things to ask to know if someone is scamming?" Right? There was a couple in Nightdale that went to prison for credit repair scamming. Now I can answer this, but I'll let you answer it, Chris.
Oh man. Repeat that question.
All right, he says, what are the things to ask to know if someone is scamming you, right? And he said there was a couple in Nightdale that went to prison for credit repair scamming.
Wow. the questions that you would ask them, basically.
To find out if
Well,
they scamming you.
yeah. Now we got protections in our state for that.
Mm-hmm.
Um, you're not supposed to pay somebody in advance
Until they clear it.
for doing credit repair. They're supposed to perform it with no out of pocket from you. Is the way I understand it. Because it's illegal in our state for them to take a fee to clean your credit up, like a mortgage rescue scam.
Uh-huh.
You're not supposed to pay for people to save you from foreclosure, but they prey on your fear of losing your most important asset, and they'll charge you for the information that they're going to give you. And most of the information that they're giving you, you can look up yourself.
Wow, wow, wow. Hey man, you need to hear this. Um Sam Blue and I remember that story. So the person that was doing the credit repair at night there said he created fake credit profiles and altered clients' data using fraudulent police reports, leading to over $1 million in intended losses. Griffin received a 100-month prison sentence.
Oh my
100
goodness.
months. Mm, that's
A
9 years.
$100
It's 9 years. Woo, hoo, hoo. I had to sing on that one.
Wow.
100 years. Yeah, I'm a singer, y'all, but I just had to do that one. I felt it in my spirit. I felt it in my spirit. See, a lot of people out here, giving you trade lines, CNN numbers, new credit profile numbers, CPN numbers. You can't use that to buy a home. I ain't gonna get into the depths of it, but you can't use that to buy a home. Yes, people are doing it, and I ain't gonna get into it. So everything. So let's get back to the mortgage protection. So while you're paying your mortgage, right? These banks, Chris, are giving people decreasing loans that don't. That's not protection, right? I call it a setup, and I'm gonna tell you why I call it a setup. Because how can I say this? Because when a husband or wife die, they need more money than just to cover the mortgage. Because now that income is lost. What if the husband gets hurt and is out of work for 6 or 7 months? That mortgage protection from the bank is not protecting the family because it doesn't cover unemployment. It doesn't cover disability. It doesn't cover critical illness, right? So I want to talk about this right here. So let me show y'all, if you're watching this podcast, what real protection look like through our company, right? So, Chris, I'm gonna tell you what our company offers because you may have clients that need what I have, and I know I got clients that need what you have, right? Say,
Right.
so with our company, we just don't protect the loan. We, how can I say it? We protect the life connected to the loan. Does that make sense what I'm saying?
Oh yeah, definitely.
We protect the life that's connected to the loan. Coverage that stays the same is not decreasing at all. And the protection that we offer are living benefits, meaning that it's something you can get now. You don't have to die to get it, right?
Okay.
You don't have to die to use this policy. Well, guess what, Chris? You sold Mr. Jones a house and he had a heart attack. Well, the bank's policy ain't gonna do nothing for Mr. Jones. But guess what? Our company has living benefits that Mr. Jones can tap into now. He can have a heart attack, stroke, cancer, paralysis, or a terminal illness. That policy will give him some money up front. And guess what he can do with that? He can use it for treatment. He don't have to use it for treatment. He can use it to pay his mortgage while he's out of work. This means that you can still protect your home while you are alive.
That's amazing.
That's what our company offers, Chris. So that's why we both up here together. You get people in the house, we protect them while they are there.
Okay.
So let's talk about some of the disability protections that our company offers. So If you can't work, your mortgage still got to get paid, people. Critical illness, critical illness cash, lump sums paid directly to you. Our company even have return of premiums. Do you know what that means, Chris?
Yeah,
That
that's
meaning
strong.
that if you calculate up how much you paying for your mortgage, let's say you paying $200,000. You got a 200,000. You pay. Let's say you pay $75,000 into this mortgage protection program. Our company is going to give you 75% of that when this mortgage protection program is over with. At that time, you
Mm,
done paid your house off, Chris. And after you paid
mm.
your house off, you got a nice savings account of about $60,000 coming to your home just for having the mortgage protection through who? Our company.
Wow.
And then we got unemployment support, Chris. Protection that stays active during hardships. The bank's mortgage protection ain't gonna do nothing if you're unemployed because they're gonna come take your house. Well, guess what? We have coverage for family, spouses, and children. They can be included as well. We have unemployment insurance connected to our mortgage program.
Wow. Okay.
Right? We got chronic illness benefits where you can access your policy early when life changes. So let me use this as an example. Let's say Mr. Jones have a 75% critical illness rider on his policy.
Mhm.
Let's say he owes $200,000 on the house. Let's say his mortgage protection is $200,000. Guess how much they're going to give him if he has 75% critical illness rider and they told Mr. Jones he got less than 2 years to live? He gonna get $150,000 up front. He can
Oh,
take
that's
care of his funeral expenses. He can put his family in place. He can pay the mortgage down, let his wife refinance it. So now she got a lower mortgage. Or Chris, guess what you can do? You can get a mortgage protection program from our company. You're now age 45. But you know when you turn 65, you might want a reverse mortgage. So guess what? Now you got a policy, a program at 45 that was affordable. Now you can get the reverse mortgage, don't pay any mortgage. When you die, guess what happens? The mortgage policy, the mortgage protection policy pays the house off and your children can keep the home versus having to sell it. People, this is not just insurance. This is financial protection. You hear what I'm saying, Chris? So this is why me and you are the dynamic duo. You're going to get them in the house. I'm going to protect them while they're in the house. So let me say this clearly. A mortgage is not just a payment. It's a promise, people. Right? And mortgage protection makes sure that your promise is kept.
Mm.
It makes sure that your promise is kept. That's why you need to reach out to me and Mr. Butler. I done call him Chris. I done call him Mr. Butler. It just depends on where I feel at when I want to say what I want to say. Right? So, Chris, how often do people get approved, right? But don't think about the protection.
Man,
How often do
a
they get
lot of them.
approved, but they don't think about the protection
Right.
at all? So,
Exactly.
listen, people. So what we are really saying tonight is this. You need both. Someone to get you approved and someone to protect what you build. Do you agree, Chris?
Man, I agree.
And see, this was a very educational episode because Chris told you how to get in the house. I'm going to tell you how to stay in the house because the chances of something happening to you physically is greater than it's not happening. So say stop celebrating pre-approvals and start securing outcomes with Mr. Chris. Because it's not just about getting the house. With me, it's about keeping it. So here's the call of action, people. You ready for me to tell them what the call of action is, Chris?
Go ahead.
I'm going to tell you what the call of action is. If you're watching this right now, right? Denied, there's a strategy, right? Trying, there's a path. Approve, there's a responsibility. So don't just get qualified for a house, people. Qualify to keep it. And that's why you need the mortgage specialist, Mr. Christopher Butler, and you need the mortgage protection specialist, Mr. Lamar Blakely. Listen, I told y'all from the very first start of my podcast, we told y'all, and we told y'all, and we told y'all.
We told y'all, we came to expose the lies and reveal the truth. We told y'all, we bring in biblical principles of factual truth.